Right. So the Fed raises rates, right? 3/4 of a point. Markets go down 500 or so points. Dow did yesterday anyway. What does it look like today?
It's going to actually be up marginally. But look, the larger picture that we're seeing across the board from anybody who owns stocks these days is they have been down and they continue to be down. And the truth is, given what we're hearing from the Federal Reserve, they would like them to go down even more. And that is the big question. And we've talked about it a lot before, Willie, this idea of hurting the economy to help the economy. It appears now that Jay Powell is speaking very hawkishly about how he plans to do this. And he really does want to raise interest rates materially more, probably another 75 basis points next month and possibly another 75 basis points before the end of the year, and probably continues this into 23. All of this is now increasing the risk of a possible recession. And importantly, and I think we need to put a point on this, he effectively said, and, you know, we talk about the dual mandate of the Federal Reserve. He effectively said that he wants to make unemployment worse. Now, historically, the Fed has said the opposite. But now you hear from him directly saying we need to increase the unemployment rate. Right now, the expectation is that we're around 3.7 right now, 3.6, 3.7, that unemployment may have to go up to 4.4% to actually help inflation come down. So, again, it all feels so perverse because what they're really trying to do is they want people to lose their job to actually change the dynamic around pricing. And I will say, and I've now talked to a number of CEOs, interestingly, over even the last 72 hours, that are saying that they've started to see a little bit of a crack in the labor market. You know, for a long time, you heard from business leaders saying, we can't find people. We don't have enough people to work at a restaurant, a warehouse, you know, blue collar, white collar. And they're starting to say that there's more people coming back into the labor market. And in some ways, that's exactly what Jay Powell's trying to do. He's trying to hurt the economy such that those who've been sitting on the sidelines saying, I have enough money to live, say, no, now I actually need a job. That unto itself may alleviate some of the supply problems on the labor side. Again, it's just such a fast, we haven't seen anything like this in a very, very long time.
So, Andrew, is it fair to say that Jay Powell is trying to reprise a bit of what Paul Volcker did in the early 1980s, and yet without the impact that Paul Volcker had, maybe having even a negative impact, a really negative impact on the economy?
Well, I think that's exactly right. And what he's trying to do, to some degree, is sort of jawbone his way out of this, rather than actually, you know, raise interest rates to 10+%. If he can say, I'm on this path, can he slow things down literally, almost verbally, by using the bully pulpit, and businesses start to say, you know what, I'm actually not going to hire some more people right now. I'm going to slow things down a little bit. And does that alleviate some of these pressures? Because the truth is that the Federal Reserve has a very blunt instrument, raising interest rates, lowering interest rates. That's the instrument. And we know that so many of these problems that are facing our economy are so nuanced. So much of them are supply side issues. You still can't get enough chips manufactured. You know, we've seen the price of food go up. Wages have gone up, which is great in so many ways, but when costs are up even higher, that's the problem, and that's what inflation is. And so these are the things that I think we're trying to get through, and it's going to be fascinating to see whether he lands the plane.
So, Andrew, the jawboning, what happens if the jawboning is increasingly successful on Powell's part? So people stop the idea of buying a new car. People stop looking for a new house. People stop buying refrigerators or clothes dryers. What happens then?
Well, in a very strange way, that's exactly what he wants. If that happens, some of those prices start to fall, right? Food prices might start to fall. Energy prices might start to fall. We've already seen some of that. That I think is more related to the fact, actually, that people are worried that there's going to be less demand in the future. That's one of the reasons we've seen the price of gas at the pump go down. So, as I said, the very strange, it feels so weird, is that the whole goal is for people to buy less refrigerators, to buy less homes. And the question mark about all of this is, how quickly does that happen? And does it happen to such an extent that it tips the economy over into a place that makes it very hard to recover from?
So, Andrew, bank CEOs, a lot of Wall Street heavy hitters talking to lawmakers on Capitol Hill yesterday and expressing a little bit of that darkness, that bearishness about the economy that you're hearing on Wall Street?
Pretty much across the board. It was almost a consensus view. I mean, maybe you have to take the contrarian view when everybody has one view. Oftentimes it turns out to go the other way. But listening to those bank CEOs get grilled on the Hill about inflation, almost all of them expect us to either go into a recession, and we can just debate the technicalities of that word. But no doubt they believe that 2023 is going to be much tougher than 2022. And you're starting to see it in terms of the profits of the companies and margins. And that's the truth. They take that down. And then, of course, it gets to workers, labor, et cetera.
Andrew Ross Sorkin, always worth the wait, even when the satellite goes down. Thanks, Andrew. Good to see you.
Thanks.
Still ahead on Morning Joe at the start.